Hello, everyone. Hello, Finimizers. Welcome to another Finimize live event. My name is Stefan, your Finimize analyst, and I'm hosting today's event about demystifying the finance industry with our partner, CFA Institute. So first, just a few housekeeping rules to run through. Number one, feel free to introduce yourself in the chat, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. This is going to be a 15-minute conversation followed by a 15-minute audience Q&A. So basically, please use the Q&A box to ask a question. And if you see a question that you like, upvote it so it moves to the top. That way we can get through the most upvoted questions first. All right, so let's kick this off. So our event partner for today is the CFA Institute. They are the global association of investment professionals that set the standard for professional excellence and credentials. They are the champion of ethical behavior in investment markets and a respected source of knowledge in the global financial community. There are more than 119,000 CFA charter holders worldwide in 160 markets. So I'm actually a CFA charter holder myself. It was a lot of work, but definitely worth it. And I would highly recommend to anyone who's considering a career in the industry or who's already in a career in the industry to do the CFA and to join the community. We'll drop a link to learn more about the CFA Institute and their special offer today in the chat box now, so have a look. And today I'm joined by Robert Stammers. He's the founder of a financial communications company that creates investment content for institutional clients. Previously, he was a director at investor engagement on the future of finance team at the CFA Institute. And prior to joining the CFA Institute, Mr. Stammers was a senior executive for several institutional fund managers, the portfolio manager of a 1 billion enhanced real estate fund, a 1.2 billion private timber fund, and several pension fund separate accounts. So I think it's fair to say Robert knows what he's going to talk about. How are you doing today, Robert?
Great. Nice to see you, Stefan, and I'm happy to be here. Thanks for inviting me.
Awesome. Great to have you. So let's dive in. We've got 15 minutes. So first, Robert, let me just, take a step back and let's talk about the finance industry. What is finance at a high level, and why is it so important for the world to function? And if possible, give some, as practical examples as possible.
Okay, well, very generally, it's really finance is about the efficient allocation of capital between capital users and capital owners. When I say capital users, what I'm saying is business people or people that are have businesses or companies or for whatever reason need capital in order to expand their businesses or keep their businesses running. Or it even could be someone who wants to buy an asset. So if you want to buy a commercial real estate building, for example, you would need capital. And so the owners of capital are investors that have capital, and they want to put it to use and get a return from it. And so finances merge those two together. And if you can think about it, I mean, if you have a business that wants to build plant and equipment, or they want to build a new store, or whatever it is that they need that capital, it's hard for them to just go out and get that capital without going through the financial system. And the financial system basically marries those people together, right? So people that need capital, get capital from owners, and owners for taking the risk get a return. So that's their payment for doing that. And if you think about it, the global economy just wouldn't run if they didn't have this allocation of capital, because inefficient allocations of capital, you'd have people running around out trying to get money from individuals. But the system has been built with regulations and rules to protect the consumer, to protect the investor and the owner, in order to make sure that that's efficient. Probably the simplest example that I can give that most people would understand is the home mortgage, right? So most people can't afford to buy their homes 100%, right? And so what they do is they go to a bank or a finance company in order to borrow money, and they borrow the debt for their home. And in order to do so, they have to pay an interest rate, and that's what compensates the investor for the risk that they're taking, that you'll pay your monthly mortgage. Another example, as I said before, would be, let's say you have someone who's a developer who wants to develop shopping centers or develop office buildings. Well, this take extreme amounts of money. And so what they'll do is they go to a construction lender first and they get money in order to do the construction. And then eventually either sell it to someone, or if they decide to keep it, they get what's called a permanent loan and they have permanent finance. So a lot of the assets that people buy are basically the other side of the coin, right? It's the investment side. So, large corporations, what they do is they do what's called debentures, which is basically debt. People buy those debentures, and it's a less risky return for providing that. Then there's the actual ownership of the business itself, which are stocks or equities, which tend to provide more return because there's more risk, because as opposed to just being a debt provider, now you're an owner of the company, just like the other owners. So if you think about that, I mean, everything that's done, shipping, people, farmers built, farming, all of this work, everything that's done, it requires capital, and the system is built in order to put those two, those parties together.
So now let's move on to the topic of investing, and it's a kind of a broad question, but hopefully you can choose to go whichever direction you want to. What are some key topics and skills that people should be comfortable with before employing an investment strategy, like the most important ones?
I would say the number one most important thing is to have very, very specific investment goals. Really understand why you're investing. So if you're if you're investing for retirement, what does your retirement look like? How much money are you going to need in retirement? If you're investing for your children's education, let's say, what does that need? How much are you going to need? Where are those people? Where are you thinking they're going to go? What's that going to involve in order to do that? And the reason for that, the reason to be so specific is because your goals will determine everything else. It'll determine what assets that you invest in. It'll determine what amount of risk that you might want to take. It'll determine, the advice that you might go out and get. It's really, there's a lot of factors that are involved, and they all emanate from those goals. So there's lots of people out there that invest and just say, well, I just want to make money. The problem with that is if you don't really know where you're going, it's very hard to get to that place. Right. And just making money isn't enough, because what happens is it tends to make people take either too little or too much risk, not invest in the right assets, and the other things that I was talking about. As I mentioned before, those goals will determine the amount of risk that you want to take. And that's the second one that people really need to understand is, what is your risk tolerance? How much risk are you willing to take? Now, there's different ways of looking at risk, but generally it's thought about the swings in the market. How much variability in the market are you willing to take? How much are you willing to let your account swing from, highs and lows? And how much of that can you take? And there's two types of risk tolerance. One is a financial ability to take risk, and the other one is your emotional ability to take risks. So if you have a certain portfolio, you might be able to say to yourself, okay, well, I'm well funded, I'm 80% towards my investment goals. And so if I lost 25% this year, that wouldn't be so bad because I have some time to make it up. So that's your financial ability to take risk. But your emotional ability to take risk is, how is that going to affect you, right? how are the swings in the market? If all of a sudden you lose 50% of your account value, are you going to divest of everything because you're so scared of what the market's going to do? And what's really important is that you never want to have to divest of your assets when things are bad, right? So you really need to understand what your limits are, right? And then try to construct a portfolio that will keep you within those limits so that you're never, you never think about, divesting your entire portfolio, getting out of the market. And why that's really important is because, depending on who you are, where you are towards your goals, will determine a little bit of the amount of risk that you're going to take. So this is why I always tell people they should, start to invest early, because as a young investor, you have time on your side, which allows you to take more risk because you can go through the swings of the market over a long period of time. But because you're younger and have time on your side, you don't necessarily have to take as much risk because of compounding of interest. Your portfolio can grow over time. So depending on where you are in your journey, kind of dictate a little bit about how much risk you're going to take, and you really need to understand how that's going to affect you and how that's going to affect your portfolio. And then I'd say number 3 is really understanding the things that you can control and the things that you can't control, right? And to focus on those things that you can control. So you can't control the market. The market's going to do what the market's going to do. It's going to go up and down. And even though, people do have predictions, it's very, very hard to understand what the market's going to do. So you really can't think about what am I going to, can I time the market? Should I, get in today because it's going to go up tomorrow? Or is it going to go down tomorrow? Should I sell a particular asset, right? Because you really can't control what the market's going to do. What you can control is what portfolio you build, what assets that you buy, and what risk management plan that you have that'll keep you, like I said, within those risk tolerance barriers. So risk management's important. Another thing you can control is fees, right? So you know that there are investment fees and there are advisory fees, and you need to really understand when you're buying a particular security or an asset, what are the fees involved? And is the return that you're going to get going to compensate you for those fees? And I'll give you an example why. I mean, you'd think 1% fee on a product wouldn't be that big a deal. But over a 40-year period, right? If you are investing, let's say, $5,000 a year, over a 40-year period, 1% increase in fees could reduce your portfolio by as much as 25% because of compounding. So it's a significant thing that you need to understand. Another one, as I said before, is don't chase yield, right? You can control what you buy, and you can control the assets that you purchase and the risk management that you put in place. And it's, for most people, it doesn't make a lot of sense to try to buy the best new thing on the market, the thing that's in the newspaper about here's the next big investment, because you just don't know what the risks are that are involved. So really understand the asset that you're buying, and make sure, like I said before, that they fit within your portfolio and you can handle the risks involved.
Thank you so much. That was incredibly wise advice, and I think that's why we have so much to learn from people like you that I've been for such a long time in the industry, and I've seen it all, and yeah, I think it really resonates with our audience, and I think this is incredibly good advice. So now let's move to the Q&A part of the webinar. So please vote for the questions that you want to see answered first. And then we will basically go by order of importance. So, are there any investment or general books you recommend?
Well, I mean, there's a lot of investment management books. I mean, there's things written by Harry Markowitz. Um, Instead of giving you ideas of the books that you should buy, what I think is a better answer to the question is find those successful investors that have a similar investment philosophy that you do, and then read what they put out or follow them. Find people that are investing in similar things or have similar goals that you do, and try, to either read their material, listen to their podcasts, follow them on social media. This is really the way to build your knowledge. Okay. I mean, there are so many good investment books that I can't, sit and recommend all of them to you. But I think what's a better thing for most people, most general investors to do is to try to find those, those successful investors that that you like and do what you do,
And I think what's also fascinating is that you can find two completely different investors with completely different methodologies, and yet they're both successful because they're just following their process. So there is basically investment strategies for almost all taste, I would say.
Absolutely, absolutely, and and that's the key right there. I mean, if you don't want to fall, if you're not a high risk investor, you don't want to be reading material or people that are taking significant risks, right? If there's someone that's purporting to just say, look, you should only invest in equities. Well, that might work for them because they've got specialized knowledge about in equities and the things that they buy. And if that's what you want to do, then that's a good person to follow. But if you want a more general investment strategy where you're, investing in a diversified portfolio of assets, then it's better to follow someone that does something similar.
Okay, so next question is very interesting. What is your strategy for mitigating potential downside risks in your investment portfolio?
Well, diversification is the key, right? And the idea is diversification is about buying different assets, putting them in your portfolio that don't move together lockstep with the market. Okay. So the idea is if the market goes up or the market goes down, you have some assets that are going up and other ones, if there are assets that are going down, there are also assets that are going up so that you have some return left over. And every asset in your portfolio should have a role in reaching your investment goals, right? You just got to make sure that you don't invest in things that are going to all move together. So I'll give you an example. So, there are different ways to diversify. You can diversify along asset lines. So, you buy debt and equities, maybe real estate, or you can diversify within a portfolio, within your equity portfolio. You might diversify among different industry types. So I want to be invested in industrials and consumables and other things because they won't necessarily move together, right? And it's another thing to really think through too when you're putting something together. Is this going to provide me good diversification? Because at the end of the day, that's the best way to reduce your risk on the downside.
Maybe can we just follow up on that question and maybe make it very practical to today's environment? What sort of investment or asset classes you reckon would be a pretty good diversifier to stocks, for example?
Okay, so the traditional portfolio, the one that most people invest in is what's called a 60-40 portfolio, right? And it's usually 60% stocks and about 40% bonds. And bonds being less risky reduces your overall risk of your portfolio. But you might want to add other things to that in order to diversify it more. So real estate is something that's very, not uncorrelated to the equity market. So if you invest in private real estate, people need to realize that their homes are all, if they own their home, that's also an asset that's part of their portfolio. That real estate can diversify your overall portfolio because it's not correlated to those other assets. And then, depending on what's happening in the market, you may want to invest in things because of a particular something that's going on. Like right now, we're in an inflationary environment, so there are assets that have that are good diversifiers for against inflation, such as commodities. And real estate's another good one because real estate owners can push the higher prices through to rents to their tenants, and thus can still provide a good return in an inflationary environment. So you look at those sorts of things, and once again, but it comes back to, as I said before, really understanding what your goals are. Does that fit into your portfolio? And is it going to do what you want to do, regardless of what's going on? Now, going back to the question, what some people do is they build what's called a core portfolio. So they build a core portfolio of bonds and equities and maybe some alternatives. And alternatives are things like commodities and real estate. And then what they do is they build a satellite portfolio, core and satellite. And that satellite is something that you might, for the short term, want to take a bet on. So you think that a particular industry or a particular set of companies are going to do better than the overall market for some period of time. You might put some small percentage of your portfolio into a satellite to see if you can get some extra return.
Yeah, I personally like that approach a lot, the core satellite approach. So the next question is about the CFA in particular. Does the certificate hold weight in the financial sector in the UK and globally?
The CFA charter? The CFA charter, yeah. The CFA charter is the premier, it's the premier thing that you can get as an investment person, right? I mean, it's similar to a CPA for accounting people, and it's a global credential. And most people that get the CFA, what happens is that companies know that you have a very, very good foundation in investment management. And it also teaches people that you also are someone that works hard, because, as you said, it's not an easy credential to get, but it is very, it's very well regarded by investment companies globally. Now, CFA also has other products other than just the charter. There's something else called the Investment Foundation Certificate, which is really a course that's built for, not for people that actually want to manage money and make financial decisions, but want to be in the investment management industry, maybe in another role, and want to understand the industry, the entire ecosystem better, so that they can provide more value to their employer. And that's also well regarded, and also a global certificate that people might be interested in as well.
Thanks. The next question is, as a beginner investor getting going, who are some good examples of investors to follow or research?
Oh, that's a really good question. Off the top of my head, I really can't think of any. There's just so many of them that provide, like I said before, it's very hard. It's very hard to generalize for people about who they should read or who they should follow, just because everyone is so specific. Even though there's generalities in investment management, it's very specific to each investor on what they want to do and who they want to follow, right? So, like I said before, if you want to learn more about the, analysis of portfolios, you might read something by Harry Markowitz, but that would only give you the analytical pieces of it, right? It's really about finding from the community of investors that you're interested in, who that you should be following. And what I would suggest for most people, just like they're coming to this webinar, is that they either find other webinars to follow that's in line with the things that they're thinking of, or even better is to find a community of investors locally, because there's lots of local associations of people, investors, and you can find other people that are like-minded that can point you to the right places to look for information, right? The other thing I would say to new investors, if they really want to up their game in investment managers, is to find a mentor of some kind, either someone you know, a family member that's done a lot of this work, or a CFA charter holder, or even maybe a CFP, which is a charter certified financial planner, someone that has significant experience investing money that can be a mentor to you and provide you a very insightful recommendations for the types of things that you want to invest in.
Thanks, Robert. The next question is about how to structure investment portfolio. So what is the best way, what is the best strategy to structure an investment portfolio? So I think you touched on the core satellite approach. Maybe you can touch on other potential ways.
Well, I think we're going to go into this a little bit more in the next webinar, but it's really, core satellite is one. The other one is to look across geographies, right? A lot of people invest locally because they understand the local market. I would say, if you look, this is very specific. This is very common in the U.S. People who are investing in U.S. stocks and don't invest abroad. But it's really important that you look at how to allocate capital to different parts of the world as well, not only looking for potential return, but also for additional diversification. And then again, it's really about, what percentages do you want to, how much of a bet do you want to take on each one of these asset classes? And so, the very high risky alternatives, most people only put a small percentage in their portfolio, right? As I said before, the top two assets are equities and debt. And then as you start building your portfolio to build additional risk management, you really don't want to take really large percentages in these other assets for a couple reasons. One is because they're not as efficient, which means the market moves and it's very hard to understand them, as well as equities in the debt market, because they're so foundational. But also because the knowledge of them is difficult to get. It's they move a lot more. They're much more volatile than the rest of the market. So I'm not sure I answered that question the way you wanted to, but I mean, that's the way I would approach it.
Yeah, maybe if I can just add something to that question. I think one I would potentially check out if I were you, Musai's all-weather strategy. It's basically Ray Dalio, the founder of the hedge fund Bridgewater, and the idea is to basically build a portfolio that can perform in any type of macro environment. So it's basically, if you have no idea what will happen tomorrow in terms of macro environment, this is a kind of portfolio that should be robust to whatever happens in terms of macro. It's called all-weather. I think that's one that might be interesting to check out. Robert, do you have maybe a final word of advice, or just general tip or word of advice to all our Finimizers?
Yeah, what I would say is, if you haven't, there's a couple things. One, you're already getting knowledge and advice. Knowledge and advice is key, right? I mean, you can't stop learning about these subjects. So being here at this webinar shows that the people here are already interested in doing that, and that's key. The other thing is to try to build your financial capability. because at the end of the day, what investment management is about increasing the probability of you reaching your financial goals. And so that means more than just investing well. That also means being financially fit so that you can maximize the amount of money that you can invest. Because, the market provides return and that helps you build your wealth. But investing continually into the market also has a significant influence on you reaching your goals. So the ability to maximize that money and continually invest it is extremely important. But what that means is that you need to really think about financially how you're set up. Do you have a budget? Are you tracking your expenses? Are you stopping any leakages, any expenditures that you shouldn't be making? Do you have good debt management? I have a over amount of debt. So once again, that you're maximizing the amount of money that you can put into the market. The other one is, this is the key one that most people on the financial literacy and financial capability side talk about, is having an emergency fund. And you would think, well, isn't that more about, just making sure that I can cover my household expenses? But really what it's about is, once again, if things go bad, let's say you lose your job and you lose your income, you have something to fall back on for some period of time so that you don't have to take your money out of the market. Because as I said before, you never want to be put in a position to have to divest of your assets when it's a bad time to do so. And that'll keep you from having to do that. All right. And the last one, I was thinking about when I was younger, how would I have changed if I could go back and tell myself, things that I know now. And the other thing would be to try to live as frugally as possible. I mean, that's not to say that you have to, not buy anything or live like a pauper, but it does mean trying to think about taking things like windfalls, like raises, any other money that you wasn't accounted for, and putting that into the market. So one way to do that is to really curtail your expenses. Some people, what they do is they go as far as making their investment allocation for the month part of their household budget, so that every month it's almost like a payment. This is the amount of money that's going into my investment account. And by doing that, you significantly increase the probability of you reaching your goals over time.
Robert, thank you so much. This was incredibly insightful. Remember, we also have 2 more events coming up with the CFA, so make sure you check those out as well. Honestly, thank you so much, Robert, for all of this good advice. Thank you, everyone, for joining. And I hope you all enjoyed it. You can please fill out the feedback form that should pop up on your screens right now. And we'll see you at the next one. Thanks again, Robert. Thank you, everyone. Bye.
Thank you.